So aside from invasive blood tests or potentially inaccurate forms, what's another way to get around asymmetric information? Have you ever noticed that insurance policies often have clauses in them that state that you will not be covered for certain events until some number of years after you purchase the policy? For example, life insurance plans often do not allow beneficiaries to receive a payment from the insurance company for 3 years after a person enrolls in the life insurance plan. In other words, if you buy life insurance and die within 3 years of purchasing it, your family will almost always receive nothing. Why is this? Is this just a sneaky way for insurance companies to deny claims? Well, not necessarily. Again, let's suppose the world is full of Amy's who are low risk and Susans who are high risk. And again, the insurance companies have no way of determining who is an Amy and who is a Susan. So they offer two different policies, right? And we'll do the same probabilities, 20% chance of a $20,000 surgery and an 80% chance of a $20,000 surgery. Okay, so the exact same situation as before. But now the insurance company is going to offer two different policies. Policy, let's call it 1, is that it's $4,000 per year, but you will be denied coverage for 1 year. So coverage, so let's say this, it'll delay coverage by 1 year. Policy 2, it is $16,000 per year, but no delay. In other words, if you go with policy 2, there is no delay between when you sign up and when you can actually make a claim, and it will be filled. Now, the Amy's and the Susans of the world can decide which policy they want to buy. What will be the likely result? Well, the Amy's of the world will be much more likely to purchase the insurance with the 1 year delay than the Susans. The Susans of the world will be much more likely to purchase the insurance with no delay in coverage. The result is that the consumers themselves self-select into what we could consider the correct insurance plan and effectively reveal whether they are low risk or high risk. Economists refer to this type of situation as a signal. The Amy's and Susans of the world are revealing privately held information, the information being whether they are low risk or high risk, through sending a costly signal. The signal in this case is the 1 year period of no coverage, but still making payment. It is costly to the Susans of the world because they are likely to have an appendectomy during that first year, which means that they would be denied coverage. This signal is not nearly as costly to the Amy's of the world, who are less likely to have an appendectomy during that first year of no coverage, and so the cost differential causes them to self-select into these different plans. Now, we see signals like this all the time, especially with warranties. A company that produces a product that is unlikely to break can offer a very generous warranty because it costs them almost nothing to do so. After all, if the product is high quality, the warranty is oftentimes unnecessary. A company that produces a product that is likely to break will almost certainly not offer a generous warranty because doing so would cost them quite a bit, as people would take advantage of the warranty every time the product breaks. So, by seeing that a company offers a generous warranty, you are actually more assured that the product in question is actually high quality.